me get over here to the slides. Okay, we'll keep them moving. So talking first about short call verticals. So we want to understand the anatomy of a option spread trade, get comfortable calculating max profit, max loss on the trades. And then when we get on the software, we're going to search for securities that meet our criteria, and then talk about position sizing and practice placing some trades. So first and foremost is the anatomy of an option trade. All right, and so the definition, or I guess the objective, I should say, for this type of trade is we are looking for a sideways trending stock or a stock that is basically made its move and we think it's kind of either maxed out or bottomed out here. And so we're looking for those kind of opportunities. And what we do, let's talk about the short call vertical first, is we sell a call and then in the same expiration, buy a higher strike call. That is a short call vertical. So same expiration, selling one call, buying another call. Now, like I was saying here, these are not the YOLO trades that you've been hearing about in the media. These are, you could almost argue, kind of boring trades, but we're not, baseball is a huge sport in America. We're not swinging for the fence with these trades. We're looking for small ball base hits here. You add enough base hits on and you start getting runs. All right. And so you're going to generate a little bit of premium, but you find enough probability in these things and you get enough premium. They're not all going to be winners, but when the majority of them are, it starts generating a nice, healthy return. All right. So moving on to our risk profile. So I think if you're not familiar with risk profiles, we've used them a little bit in our previous slides, but they're really useful. And you can see on this slide here, to the right here, the graph, with the short call vertical, your profitability range is on the downside. So if the stock really stays where it is or goes down a little bit, you make money. If it does what you don't think it's going to do, if it goes up, if the stock goes up, you are going to lose on that trade, but there's a max loss on it. So if you're just selling a naked call, just selling a call outright naked, there's no limit to how much money you can lose. The stock can keep going higher and higher and higher, and you're going to keep losing money. With a vertical, we're capping our max loss. Calculating, well, we'll do the calculation here in 1 second here, but let's talk about an example really quickly. So we're going to use this one for our example here. So certain stock XYZ is trading, for example, at $46 per share. You decide to sell the 50 strike call option for a premium of $2.25. All right, so you've done the math here. The stock's trading at 46. You don't think it's going to go higher than 50, so you sell the 50 strike call for $2.25. Now, if you just sell an outright naked call, your risk is that stock goes to 100 or 200 or 300, no limit on how high it could go. And you're going to lose money every time it keeps going higher. So to counteract that risk, to make it a risk defined trade, you decide to buy a higher strike call, the 52 strike call. Now you have to pay for that. It's going to cost $1.25. So there's only a total premium of $1, which we know in our options course, that's equivalent to $100. We take the short call credit of $2.25, subtract the debit of $1.25 equals $1. So the most we can make on this trade is $1. What's the most we can lose on this trade? Well, the next slide is going to show us all about that. So let's talk about max profit and max loss. I love just kind of slowing down, at least when I was learning these types of strategies, and understanding exactly what can happen throughout the life of this trade. Is once you understand that, options are really easy. Options are not scary at all. Once you understand exactly what can happen, your best case scenario and your worst case scenario, it's really comfortable to be in these types of trades. And we'll show you why right now. So again, same situation here. In the previous example, stocks trading at $46 per share, sell the 50 strike, buy the 52 strike for a $1 credit. Now the third bullet point there says the best case scenario is if the stock closes below $50 on expiration. If that happens, we realize a $100 profit. The stock is below $50 per share at expiration. We keep that premium. It's a $100 profit. The worst, absolute worst case scenario here is if the stock closes above 52 on expiration. In that case, there's a $100 loss. All right, so again, to recap, stock below 50, both options expire worthless. What happens then? They just get removed from your account. There's no fee for that. There's no charge for that. It doesn't cost anything. The options are just removed from your account. Trade's over. You keep the premium you sold it for. Worst case scenario, the stock is above 52 at expiration. What happens then? Well, when you're short a call and it's in the money at expiration, you get assigned. And if you remember, that means you have to sell 100 shares per contract at that strike price. So you sell 100 shares at 50. Now, the stock is above 52. If it's at 52.01 or 520.01, it doesn't matter. As long as it's a penny or more higher than $52 per share at expiration, it's going to be automatically exercised. And what happens then? Well, we buy 100 shares at $52 per share. So selling 100 at 50, buying 100 at 52. What is that? That's a $2 loss. But remember, we keep the premium that we initially sold it for. So $2 is the distance between the strikes, 50 and 52, minus the $1 credit. We're basically risking $1 to make $1 with this particular situation. Someone was asking for today's deck. If you here, let me highlight it. If you take a look at right here, related content, it should be downloadable right there. I'm just glancing over to the Q&As here, right? I get confused with puts and calls. Hey, we all do. Don't worry. We're not talking about puts right now. We're only talking about calls. So this is a situation where we're selling a call spread because we believe the stock is going to stay below a certain strike. We're selling a call spread because we think it's going to stay below $50 per share. And I think this question might have came in before I mentioned this, but what will happen when the stock goes up above 52? Oh, maybe this is the question. Before the expiration date. Good question. And that's actually what that video talks about. So again, the video under the related content section, I actually get into that. We talk about chances of being assigned. If it goes up above 52 before expiration, there's a chance that the 50 could get assigned to us, but it's not likely. Anytime an option is in the money, the owner of that option has the right to exercise, but it's not likely that they will unless it's deep in the money or we are basically at the expiration date. Again, I talk about that in the video, so make sure you consult that video. Try to do it after today's show. Can we enter as one trade or two separate trades? It's recommended you do this as one trade. Most people don't really have the buying power to do it as separate trade. What I mean by that is if you sell a call before you buy protection, it's going to have a very large margin requirement. Maybe you have a big account and you do have enough buying power, but I would recommend doing it as one trade. And we are going to, when we do a demo later tonight, we're going to do that as one trade. Okay, how the trade can end. So what if the stock goes up a little? Now, this is interesting because the previous slide, we were just talking about best and worst case scenarios. And now is if the stock is below 50 or above 52. But what if it's right in the middle? So let's say the stock goes up and closes at 51 on expiration. Well, if the call is in the money, if the short call, not if, in our example here, the call is in the money. The short call is in the money. It's going to get assigned. We're going to sell 100 shares at $50 per share. The long call, the 52, is worthless. It gets expired as worthless and removed from our account. So we are now going to be short 100 shares at $50 a share over the weekend. So you're going to have to sell the stock. Sorry, you sell the stock at 50, then you have to buy the shares back in the open market on Monday. Assuming they're still trading at 51, that's going to be a $1 loss. So the 50 strike is going to get assigned. You buy it back at 51, or right before expiration, an hour, 2 hours, a couple minutes before expiration. Try not to wait until the last couple minutes, but it's trading at 51. The stock is. So your option is just worth intrinsic value. It's just worth that $1. You buy it back for $1. So either way, you're paying $1. So that's a debit. You still have that net credit that you received from selling the vertical of $1. So your total P&L on the trade is $0. So it's trading right at 51. You will break even on this trade. So this is an interesting thing to talk about right now. Did anyone see the news with Peloton? P-T-O-N. Peloton is a home exercise equipment manufacturer. I'm not sure if they're international. They might just be in the States. But people in Singapore and Hong Kong probably don't have enough room in their apartments to even fit a Peloton. But anyways, there was bad news that came out with a consumer protection agency over the weekend. So the stock closed at a certain price over the weekend. Let me actually see. I'm not sure exactly where it did. Stock closed at 116 over the weekend, but now it's trading lower, down around 108. So here's the risk here, or in this case, actually, you could think of this would be a blessing. What if we were in a Peloton short call vertical and we sold the 115 and bought the 120? The stock closed at 116 and change. So basically the same situation as this slide right here. We would get assigned on the 115s and have to short the stock at 115 if we didn't buy back the call on Friday before trading stopped. Over the weekend, before Monday morning, the stock drops. It's down almost $10, well below 115. Well, we would be able to buy back the shares at Monday's opening price at 108. So not only would we keep the premium that we sold the spread for, we would sell stock at 115 and buy it back at 108 for a huge potential gain there. Now, this is very rare. I wouldn't count on this happening. And it also could work out against us. We're talking specifically about selling verticals right now, but you can buy verticals too. Obviously, you could have bought the 50 and sold the 52 and paid $1 for it. And then you exercise your 50 on Friday and buy 100 shares at 50 because it closed right in between your strike. And then bad news comes out over the weekend, and all of a sudden, your stock that you bought at 50 that was in the money by $1 on Friday is now well less than that on Monday, instant losing position. So there's that risk there. Based on this example, if the stock is 51, buying back from the market is auto, or do we need to initiate? You need to initiate the buy-in. Good question. So let's say it's Friday before expiration. Market is still open on Friday. Still got a couple hours to go, whatever. And it's trading right in between your strike. And you don't want that weekend risk, which is kind of likely. You don't want that weekend risk because anything can happen with the stock over the weekend. We don't know what's going to happen. In most cases, the stock doesn't move that much, but it could be something bigger than just, the individual stock news moving. It could be overall markets moving that could have the adverse effect on the stock. Anyways, the point is, as an options trader, especially trading these verticals, we are doing this because they're risk defined. We know what our max loss and max profit is. But if we don't trade out of the option position when the stock is in between our strikes at expiration, there's a new level of risk on there because we're taking delivery of shares or we're going to be short shares. Either way, there is more risk or different type of risk on the table. So manually, you need to go in there and trade out of your option if you don't want to be assigned or exercise the option. All right, this is the example that we looked at in our first slide. Basically, let's say the stock races up to $54 at expiration. Both legs are going to be in the money and they're going to be automatically exercised and assigned. So our max loss here is distance between the spread minus the credit that we received, $1. Max loss is $1. Best case scenario, like we already discussed, we were right. The stock was trading at 46. We sold the 50.52. Now in this case, it closes at 49. Well, it's still out of the money. So we have our net credit. $0 does it cost for us to let it expire worthless. So we keep max profit of $1 there. Think about how great this is. We were in a trade where the stock was trading at a certain point and we sold the 50.52 spread, which means we wanted the stock to just stay below 50. This is kind of it's a neutral position and a little bearish. We want the stock to go down or stay where it is. Well, we were wrong. It didn't go down. It didn't stay where it is. It went up. In fact, it went up $3, but we still made our max profit because we sold one out of the money. Now, it's unlikely that we would get this much credit for it. We probably wouldn't get more than maybe 50 cents for that. But the point is we're selling it out of the money. We'll get into, some of the deltas later about how to, choose your strikes. We need to learn how to balance our risk and our reward with whatever we're comfortable with. All right, here's where we wanted to, I wanted to demo stuff on the software, but I'm just going to wrap up our short call vertical deck before we bounce over the software. Similar to our last deck, we're talking about we want liquid options that have tighter spreads as opposed to wider spreads. And then our sample entry consideration, again, looking for something between 20 and 50 days out. Our strike selection. All right, here's the thing. For a short strike, the low deltas can increase probability of success, but they decrease profit potential. So look at our option chain here on this slide. So we have delta from 40 down to 27. Obviously, the further away from the stock price we go, the higher the strike, the closer to 61, the less delta there is, which is good for us because that's a less probability that it's going to be in the money. So that increases our probability of success, but decreases our profit potential. Now our long strike, again, it's going to be above, but still close to the short strike to balance that risk in return. So again, in the lower right-hand corner of this deck here, let's just assume we chose the 57 strike. That's the one, the 37 delta, giving us here, a 63% probability of max profit. Okay, so we sell the 57. We can choose to buy the 59 to cap our losses there. If we're wrong and the stock goes higher. So we're going to get a lower net premium, but also lower risk. Buying the 59 is going to be more expensive than buying the 61. Obviously, the further out of the money you go, premium goes lower. So we sell the 57. Let's say we get $1 for that. How much does it cost to buy the 59? Well, it might be 75 cents. So we're really only capturing 25 cents there. But if we buy the 61, that might only cost us 50 cents. So then we receive a total of 50-cent profit. The point is here, if you're wrong about the trade and the stock is higher than 61, you're at a much larger max loss. It's a trade-off than you were if you had bought the 59. Again, high probability investors will typically look to establish their short leg with at least a 40% chance of expiring out of the money. So we want at least that 40% chance that it's going to expire out of the money. All right. If we're getting near to expiration, if both options are out of the money, consider closing just a short position when the ask price of that short call is 5 cents or less. Now, when that happens, the ask price is 5 cents or less, we're basically going to be at our max profit at that point. Now, depending on how much we received in premium, it might make sense for us to buy that back. And the reason why I say that 5 cents is that while we have gotten rid of the ticket charges for options, there's still, sorry, my neck is really hurting me. There's still that per contract fee for options contracts. We waive that for buying back short legs that are 5 cents or less. So it's a way for you to, once you've almost reached 100% profit, to basically take the risk off the table and no commission for that. You still pay for the option. It's trading for 5 cents. So you got to buy it for 5 cents or 4, 3, 2, or 1. Meaning 5 cents or less, there's no commission on it. So if it's getting close to expiration and your short leg is 5 cents or less, consider buying it back because there's no commission on it. Or you could roll the dice and let the trade go to expiration, because if it expires worthless, then you don't even have to pay that 5 cents or 4 cents, 3 cents, 2 cents, or 1 cent. It just gets removed from your account. On the last trading day before expiration, if the short option is in the money, consider closing both sides of the trade, meaning buy back the short and sell the long. Or consider closing the short leg and letting the long expire worthless, because it's possible that at this certain point, while the short leg is in the money, the long leg's out of the money, the long leg might not be worth anything. So you can't sell it. But if you don't want to be assigned, consider at least buying back the short leg. If there's value in the long leg, try and sell that one too. You can trade out of it as one trade. If both strikes are in the money, consider maybe just letting the trade go to exercise assignment. You'll realize your max loss. Consider commissions. There are no exercise assignment fees anymore, which is good. So that's another thing to think about. If they're both in the money and they're trading at basically intrinsic value, you're going to realize max loss if you trade out of it or if you let them exercise. But if you let them exercise and assign, there's no commission on it, and there's no exercise fee. If you trade out of it, you're still paying that per contract commission. So depending on the number of contracts you have, if it's a one lot, one contract, which means 2 because it's a vertical, it's not that much money. And it might make sense just to buy the spread back because you can maybe get it for a little less than its full intrinsic value. But those are some things to consider as we get closer to expiration day. Let me see. There's a couple questions here. Just want to make sure if I'm able to reply. Some people ask questions that are very specific to their accounts. So just want to make sure that they are ones that can address. Does TD close the option on Friday, closing bell, or during after market? So here's the thing. If you have, think about this. If you're trading like Amazon or Google, some of these higher priced stocks, and you're trading a vertical on it, and the stock price is in between your strikes. If you get assigned on it, it could potentially be a very significantly large stock position. You might not have enough money in your account to handle, whether it's long or short, that stock position. Our margin department might be required to go in there and close the trade before it gets taken to assignment. But there's no guarantee that they will or won't do that. So the point is, know and understand the risk involved with your options positions and where it's at on that particular day. If the option is in the money at expiration, it closes in the money, it's going to be automatically taken care of by us. There's nothing you need to do. We'll automatically exercise or assign it. All right, let's see. How can we calculate the commission? Commission rates, gosh, I'm not sure exactly. I should know this. I think they're either 65 cents or 75 cents per contract with no ticket charge. I think everyone's on the same rate now. It used to be different, but everyone's across the board the same. 65 or 75 cents a contract. I should know this, but I don't know off the top of my head. Is there any function on TD Ameritrade that we can alert market opening hours, GTC, how to activate? So options actually only trade during the regular session. They don't trade GTC, only during the regular session. What is the risk of 10 contracts doing a 10 bull put spread at minus 10 delta? We'll get into the puts here in 1 second. Here's a question that I was waiting to come in because it always does. Let me just advance the slide so we can keep moving here. Talk about our sample routines, daily, weekly, and quarterly routines. What happens at Friday closing bell? The short call is out of the money, but during Friday post market, it moves in the money. Will you be assigned? The answer is most likely yes. So talking about our example before, let me just push this slide real quickly. So how about this one here? We were right. We sold the 50.52 and the stock closed at 49. 4 a.m. Singapore, Hong Kong time. The stock is at $49 a share. Bell rings. It's Friday. Market's closed. It's over. We're out of the money. What if that news comes out right then and there and the stock goes up higher and goes up to $51 a share? It's very possible that the person who owns that 50 strike call is paying attention and decides to exercise. We could get assigned. Absolutely. There's nothing we can do at that point. At that point, it's too late to buy back the call. Market or options trading is over. So to avoid that from happening, that's why we talk about these sample exit considerations. If it's $1 away or 50 cents away or even like 10, 20 cents away, which is very close actually, especially I think if it's closer to your strike, right at the market close, the option shouldn't be trading for much more than 5 cents. If you're worried about the stock moving in the post market, just buy it back. Just buy it back. It makes sense to take that risk off the table. And it kind of depends on the industry you're trading. I mean, there's certain industries that a little bit more risky, like pharmaceuticals, tech names in general can have that additional risk. But yeah, if it goes in the money in the extended hours, you definitely can be assigned. Options actually, this question, when will the option expire? When the bell closes on Friday or on Monday's open? The answer is neither, actually. Options actually expire on Saturday. Actual option expiration date is the Saturday after the third Friday. So that's why there's all that trading that happens on Friday during the regular session and the post market. You can still exercise options because they're not expired yet on Friday. It's only on Saturday when they expire. The OCC then gives us a list of all the assignments that were randomly assigned, and then we input those into customer accounts over the weekend. All right, I want to get to this slide, and then we are going to bounce over to the software and run some scans and look for some potential opportunities out here. So I created, I'm not sure, this is, now that I'm looking at it, kind of blurry. So hopefully you're able to see this on the PDF downloadable deck. So again, just examples, not something that not intended as a trading recommendation or a scan recommendation to start putting trades on based on this scan criteria. But I want to give everyone something that they can use to build off of and then tweak to match what they're comfortable with in terms of risk and reward. So potential criteria number one, the stock is 10% or more higher than its 30-day simple moving average. So we're looking for potential short call verticals. Stock is 10% or more higher than its 30-day simple moving average. We'll add that as a search or a scan criteria. If implied volatility percentile is 65% or higher, could be another criteria. We're looking for stocks with relatively elevated volatility is a good, sometimes can be a good criteria for looking for decent premium in options. Number three, does not have an earnings announcement in the next 30 trading days. With earnings coming up, selling or buying options is really kind of like flipping a coin. I mean, not exactly, because you can still have some kind of insight about what you think the stock will report in terms of their earnings, how they did last quarter, but still the stock likely is going to move big up or down or stay where it is. No one has any clue what's going to happen on earnings. So to increase our probability, we want to search for criteria for stocks that don't have an earnings announcement within the time frame that we are scanning. We want to scan in all optionable and intersect with stocks. All right, we're over to the slides now, talking about short put verticals. Consists of selling a put and then buying a lower strike put. Then that will give us a short put vertical. Similar risk reward graph. Only this time, if the stock drops, that's where our max loss is. If the stock stays where it is or goes higher, that's when we reach our max profit. All right, an easy example here. Stock's trading at $50 a share. I don't think it's going to go below 48, so I choose to sell the 48 strike put, and I receive $1.15. But I want some protection on the downside. I've been wrong before, and I'm going to be wrong again. If this is that situation where I'm wrong and very wrong, and the stock goes well below 48, I want to cap off my losses at 46. So I buy the 46 strike put and pay 35 cents for that. So our total premium we collect would be 80 cents. $1.15 minus 35 cents, 80 cents. Simple enough. Okay, if the stock closes at 51, both sides are out of the money. They both expire worthless. We just keep our premium of 80 cents. What if we were wrong and the stock falls to 47? Well, here's where it gets a little bit complicated. If it closes at 47 at expiration, our 48 is going to be assigned. So we're talking about now, it's expiration. It's after Friday, 4 a.m., our local time. The stock is at 47. We still have our 48 short strike on. We're going to be assigned. We're going to buy 100 shares at $48 per share. So on Monday, if we don't want that stock position, we're going to have to sell it. Well, if it's still trading around 47, we could sell it at 47. That's a $1 loss. Or right before expiration, again, a couple hours, whatever, if it's trading at 47, we could buy back the 48, and it should be trading around its intrinsic value. Again, dig back deep to week 2 when we talked about intrinsic and extrinsic value. We know as we get close to expiration, options gravitate towards their intrinsic value and start having no extrinsic value left. Intrinsic, obviously, is just going to be the difference between the strike and the stock. That's $1. So we can choose to buy that back to not have that weekend risk. Either way, we're assuming $1 debit. We received 80 cents for selling it, so our total loss on this trade would be 20 cents if we get out at a $1 debit. Say the stock falls to $45 a share. I was right about my worries of being wrong. By selling the 48 strike put, it went much lower than 48. Thankfully, I had the protection there at 46. So I get to buy 100 shares at 48 and sell 100 shares at 46. Obviously, it's a $2 difference there. So $2 loss minus the initial credit of 80 cents equals a $1.20 loss. Common pitfalls. Traders may fail to realize that if the stock is between the strikes at expiration, they may be obligated to sell the stock at the strike price of the short put. It behaves like a short put strategy. At that point, it's basically just like the short put that we have on Apple. We're just short the 125 put. We have no protection on the downside. But if we had a spread trade and it closed in between our strikes, we're obligated to take on the shares. May fail to understand that the stock may have a lot of fluctuation before possibly getting to max loss. Traders may fail to understand the strategy could be used when the stock has been sold off down to support. Here, the volatility is higher, possibly creating higher probabilities and higher premiums. Someone said, why is it that if it falls below the strike, it won't necessarily be assigned? That's where I would say pay attention to these videos. Go ahead and watch that video and let me know if you still need help with that. Basically, there's still extrinsic value left in the option. If there is extrinsic value left in the option, the owner of that option will not, should not exercise it. If there's extrinsic value left, it makes more sense for them to trade out of it as opposed to exercising. In that video, I talk about how to find that on the software. Similar tips for exiting if you're close to expiration and the option is 5 cents or less, possibly just want to buy it back and end the trade. If your short strike is in the money, long strike is out of the money, might make sense to just buy back the short strike. You might be paying a little bit of that extrinsic premium, but it's probably worth it to avoid that weekend risk. Iron Condor is just a put vertical and a call vertical combined. It's both of them. Take advantage of markets that are just fluctuating in a range, and you receive significantly more premium for basically the same amount of risk. Probability significantly less, though. There's always a trade-off. So you're going to get more premium with iron condors, but less probability of success. We'll talk about why. All right. Obviously, like I said, it's a short put spread and a long, and a short put spread and a short call spread is a short iron condor. This slide hopefully will be helpful. Okay. So we've got this option chain. Look at the middle right there. The strikes running up and down the middle of the screen here. The 80 strike. To the left and the right, I've got them labeled there. ATM stock. So that's where the stock is. The stock, that's the at the money strike, 80. As you go lower, the calls are in the money. As you go higher, those puts are in the money. So we decide to sell out of the money, call spread, sell out of the money, put spread. Let's start on the left here. Stock's trading at $80. We go up to the 83 strike and decide to sell that and buy the 85. We get a credit of 70 cents, a net credit of 70 cents for a 2-point wide spread. On the put side, we go equidistant from 80 to 77, so $3 away again. We sell the 77 strike and buy the 75. Here, it's a 2-point wide spread, just like on the call side. For this one, we get 80 cents credit. It's called put skew. There's a little bit more premium in puts than there are in calls. So what's our max profit now? Well, we get to add both of those, 70 cents and the 80 cents. So our total credit is going to be $1.50. And what's our max loss? Well, it's the difference between the strikes minus the credit received. Difference between the strikes is $2. 83 and 85, $2. 77, 75, $2. Minus the credit we received of $1.50, max loss is 50 cents. So you might be thinking, well, this is brilliant. I'm loving this. I'm risking 50 cents to make $1.50. Do this all day. The reason why, and you might already be realizing this, the reason why is that our profitability range is very finite. It's got to be higher than 77, but lower than 83. It's got to be within the $6 range at expiration for us to make that max profit. When we're selling a put spread, the stock could be just higher than our short strike. As long as it's higher than 77, it didn't matter where, we'd realize max profit. 77, 80, 87, 187, didn't matter where the stock was. As long as it's higher than 77, max profit. Same thing with the calls. If we sold a call spread anywhere below 83, it's max profit. With this one, we do have that tighter range of just $6 in this example here. So this is what the risk profile looks like for an iron Condor. So we've got break-even points. Max loss is on both sides, left and right. We realize that max loss there. Max gain, again, is in that range there. But the good thing about this is that since we're receiving such high premium, is that our max loss should be similar to what our max gain is, if not maybe in our favor a little bit. So quick example here, stocks trading again, $80 a share. Sell the calls, 83, 85 strike call spread for a premium of 70 cents and 77, 75 strike put spread for 80 cents, total credit of $1.50. This is just a recap basically of the slide we saw previously. Max profit, $1.50, which is our net credit, max loss of 50 cents. Here's one possible end to the trade. Stock closes at $86 per share at expiration. So we were wrong. The stock went up much higher than our call spread, went through our call spread. We know from learning about short call spreads is that they're both going to get assigned or exercised. So we have to buy the shares and sell the shares for a total loss of $2. But we keep that $1.50 credit. So our profit and loss per spread, our loss per spread is only 50 cents on this one. Now, what if we were wrong on the downside? What if the stock goes down, closes at $76? Now, this is another situation where it's in between our strikes. Remember, we sold the 77, bought the 75. It's trading at 76 now. The short put is in the money. It's going to be assigned, or we have to buy it back for $1. It's $1 in the money. Short the 77, stock's trading at 76. It's worth $1. So we can buy it back for $1 or take that assignment and hope to trade out of the stock position on Monday for only $1 loss. Either way, we're getting out for $1. So in this case, though, as opposed to our verticals, in this case, we received a $1.50 credit, but only have to pay a $1 debit to get out of the trade, still realizing a profit on this trade. So we were wrong. Stock went below our short strike on the put side, but not through both of our strikes. In this case, we still made profit on this trade. Then, of course, best case scenario is if the stock closes right in the middle of our strikes and we just keep the premium. of $1.50. Similar to our other options trades, we're looking for, stocks that are trending sideways. And also, here's kind of a newer one for criteria here. Open interest at a minimum of 20 times the number of contracts traded. All right, so depending on the number of contracts we're going to trade, we want open interest to be 20x of that. Just another way to kind of gauge liquidity with our options trades. So for instance, if we want to trade a 5-lot iron Condor, then minimum open interest should be 5 times 20 of at least 100. Open interest 350, that one qualifies. Same deal here with choosing our strikes. Pay attention though on this slide, the lower left-hand corner, looking for a possible ROI. Max gain divided by max loss should be greater than 30%. All right, max gain divided by max loss should be greater than 30%. Now, obviously, with our example, 150 divided by 50 is 300. It's much greater. But when we take a look at some of these real life examples, we want our ROI to be greater than 30%. Exit considerations also the same as our short verticals. Sample exit routines. If there are 20 plus days until expiration, do nothing. Be patient, because typically at that point, you're not going to have the type of theta decay that you're looking for. So be patient. Even if the stock has gone through your strikes, be patient. Don't do anything yet. Let the trade work. The worst thing that you can do, I think, is that you get into a trade, be comfortable with the risk, and then it goes against you right away. And so you trade out of it at a loss, but then 20 days later, by expiration, the stock comes back and it's within your profitability range. And if you had stayed patient and just stayed in the trade, you would have realized that max profit. Instead, you traded out at a loss. So with that much time left, don't do anything. If there are 10 to 20 days until expiration, consider maybe scaling out of your position. That's why I like being able to do at least 2 contracts, 5, 10 contracts at a time, because when we're at a profit and there's still, 10 to 20 days left, we can maybe get out of a portion of them. And last week of expiration, consider exiting the entire position, especially if you've made 75 to 80% of your max profit. This is what we did with Baidu, except we did it basically right when we got into it, because we were at 80% profit. So we just rolled it up to a different strike to receive some more credit. So anytime you get to that kind of level there, when you realize 75 to 80% of your max profit, consider exiting the entire position, because I think that's a profitable trade. You're not going to go broke making money like that. All right, that's the last slide for tonight.